Hi, welcome to Let's Learn Markets.
So hi guys, welcome to Let's Learn Markets. So today, as we promised, we are going to see why the marquee indexes of the Indian equities, Nifty and the corresponding index for the banks, Bank Nifty, rose even after opening extremely gap down in the wake of the RBI Governor resigning and the ruling party losing its sheen when it came to the state assembly elections. So the first thing you all have to understand is that the markets never react twice for a particular event. Even when it comes to the budget, when it comes to an election, when it comes to the results of anything, when it comes to any law or regulation being passed, when it came to GST, when it came to demonetization, when it came to recapitalization, it always followed the same pattern. Even when recapitalization was introduced, the first time the indices rose by an extreme percentage. It opened extremely gap up the next day and it continued to rise, with several banking stocks returning up to 30% in the next subsequent day. But when it came to the same recap again, the second time the same thing was announced and the recap was actually given off to banks, we do not see a similar rise in the indices. So, a primary reason for these is that the index has already digested that particular event, or we call it, in market terms, we call it the market has already eaten up that event and it is not going to eat it up again. A market is like the tiger, it only eats when it is hungry, it never eats because there is food. So once a market has eaten or digested a particular event, it doesn't react for it the second time. So when it came to the assembly election results, the first thing to notice is that we already had exit polls which extremely favored the Congress party. And the next day, as you'll be seeing on the screen right now, the indices opened extremely gap down. We had an extremely bearish run. So what happened? So what were the investors thinking? So the first thing that goes to the investors' minds is that the government stability is at risk because these elections are seen the stepping stone for the general elections of the next year. So when the Congress has had won more than the BJP, it automatically signaled a weakness in the ruling party and the possibility that the ruling party may not continue its tenure for the next year. So what exactly happened that propelled the market instead of bringing it down during this session when the results were actually out? The first thing is that the market had already went down, so it is not going to go down again for the same event. But because of the RBI governor resigning, there was huge negativity. There were huge negative vibes around the Indian market. The Indian rupee had lost almost close to a rupee against the US dollar, posting its largest intraday loss in the last 5 years. So internationally, there was huge bearishness on the Indian markets. But the fact remains that, as we discussed in our webinar that we did yesterday, and we'll be uploading that on YouTube as well. So, as we discussed there, the fact still remains that several of RBI's contentions, those against the government, were actually not rational. Except this one contention where RBI refused to give out government without acknowledging it as a borrow, though the government had sufficient reasons to get money from the RBI. Other than that, almost all the reasons that RBI gave were irrational. They had extreme degrees of irrationality linked with them. So, automatically, the RBA governor's resignation came instantly as a shock because the government did not anticipate that, though we all anticipated that in the previous MPC committee meeting. When the previous meeting was held about 2 weeks ago, there was a rumor, the rumor mill stated that the RBA governor was going to resign. And we had sufficient cause to believe the same, but it didn't happen. But the RBI governor resigned suddenly. What went into the investors' minds was that the stability of the Indian rupee was at risk. But what they understood later was what we discussed in our previous webinar. We are not actually jeopardizing our Indian rupee's long-term stability. We are actually encouraging our short-term growth, which is absolutely essential to our economy. Because we cannot expect to grow at about 7% or 8% without a short-term driver being in force. Our growth has fallen down. Our factory IIP production has reduced. So to get these industries up and kicking, we need funds, and the RBI was the burden. It was the barricade between the government, the companies, and the funds. So once this was removed, the investors initially, though the investors saw that there was a negative vibe around it, they understood the positive reaction of the corporate companies. They understood that the companies saw it as a good move because they could get more funds, they could gain the benefit of leverage, and they could have exponential growth. So it was only because of this possibility of extra leverage, extra credit that the companies had, that the shares of companies started skyrocketing. They actually did, because in the sessions we had rises in Nifty of 80 points, and today we had about 184 points. So combined we had about 260 points in Nifty. In Bank Nifty, just today alone, it rose by over 300 points. And that too, this recovery came after Nifty was bet down by 200 points at its weakest point intraday. So this signaled a strong move. This signals a strong move by the investors, a strong faith of the investors. Most importantly, the domestic institutional investors, that the resignation of the RBI governor was actually a good move in disguise, disguised as a weakness to the Indian economy, disguised as a potential threat to the stability of the financial stability of the Indian rupee. So we discussed all these earlier. So though in the short run, though in the initial periods, investors saw it as a huge bearishness, particularly because of our over dependence on Singapore Nifty for basing our opening. One thing that all investors have to understand is that Singapore Nifty is not a basis for our Indian Nifty's opening. Singapore Nifty is only a futures contract traded on Singapore. So instead of the spot reflecting in the futures contract as it is meant to be, right now what is happening is that the small investors' sentiments are being affected by the futures price than the spot price, since it is traded 24 by 7. Though the retail investors fall for this, the institutional investors don't fall for this. We had good institutional investor inflows into equities, which pushed up the equities and started off the rally. So technically speaking, Nifty has broken up the 20-day moving average today, and it has also met its peak today at the 200-day moving average. So any further up move of the Nifty above the 200-day moving average is going to propel it towards 10,900 and 950. So apart from these technicals, what actually matters is that the Indian investors, greatly influenced by the institutional investors, have put in huge inflows, have put in huge sums of money into the Indian equities in the wake of the Congress party winning and the RBI governor resigning. So though now I'll tell you one important thing that is going to happen in the future, enough of analyzing the past. So what is going to happen is that now the investors know that Congress is a force to reckon with in the coming election. So again, there will not be any volatile or violent movements in the indices. There won't be any trading gaps in the indices if the ruling party is going to change. There will only be a gradual increase or fall in the index levels, because people have already started taking cognizance of the fact that the rule of the BJP is not as unquestionable as it was thought to be, as unchallenged as it was expected to be, as unmatched as it was touted to be. So today we see that even the greatest of the elephants can be fallen. So when the investors recognize this, they'll slowly tend to withdraw their funds or slowly tend to accumulate into the market. So we won't be seeing an instant drop in the Nifty or instant drop in the Bank Nifty in the coming months, but we'll be seeing a gradual slope, either upward or downward, indicating the change in the ruling party and change in the party politics, dynamics, and the economics of the country. Overall speaking, again, the investors this time have taken an extremely wise decision to go behind actual economic growth, which also includes achieving the short-term economic agenda, going for the short-term economic goals, than just looking at the stability of the rupee. Because all these years, when we have always focused on stability of rupee, on maintaining the stability of rupee, we have never grown as much as we have this time. The stability of the rupee automatically comes when there is good and sustained growth of the Indian economy and the products. So when your manufacturing sector, your primary sector, and your tertiary sector, your services sector is going to grow by leaps and bounds, automatically your GDP is going to kick in new highs. Your credit rating is going to increase. Your debt is going to decrease. And people are going to invest more in your economy. So your rupee is automatically going to get stabilized. And this is how national economics work. And this is the difference between academic and practical application of economics. So again, here I am not against the RBI's line of thought. I'm not against any person, but the fact still remains that the RBI this time was a bit too protective and a bit too cautious, that it didn't see the agenda of economic growth and rather focused only on the conservatism of the Indian rupee, something which the previous governors of the RBI took a risk on is not being taken right now. We saw huge risks being taken when India's gold was pledged at the time of the 1992 crisis, but this time no person is ready to take any risk, primarily because of the extremely weak credit situation in the country, especially after the demonetization. Though liquidity came down initially, it has gone up in the recent times. RBI is afraid for its own reasons, but though the RBI has extremely good reasons to be worried of, the fact still remains that the RBI is expected to take risks when it comes to economic development, because that is the way countries develop, that is the way economies mature. If we go the RBI way, we are not going to develop at least till 2035. It only takes simple math to prove that if India is going to better China, China is going to have to grow at 0% for the next 10 years, and even if India grows at 10% for the next 10 years, it is not going to happen. And China is one economy out of the five that we want to better. So, economic growth is full of risks, but these risks are definitely worth taking considering the Indian development story that we have been witnessing. And the Indian growth story has always been positive, and this Indian growth story has been proven several times in the past. Several times. Not a single time has the Indian growth story disappointed any one of us. Just like how Warren Buffett says, I buy American and so I am. We say, be Indian, buy Indian, because the Indian growth story is never going to fall apart. We are a country that is full of people who realize their potential in spite of all the difficult situations that they are put in. So this is definitely a passing phase for the Indian economy, and going forward, no matter what party is at the helm, we have able finance ministers with a good knowledge in economics, with good knowledge in monetary economics. And one thing that concerns me though is that the RBI, though is not mandated to work, they are supposed to work, because only if they do, the Indian growth story goes forward, or else we'll be seeing stagnating growth. Again, I tell you, we are on the brink of a global economic growth and debt disaster. There will be a serious stress on the fiat currencies that the world has currently. Take the example of the Japanese yen, Japan, China, Germany, already your developing countries like the Turkey and Greece, they have all fallen apart. Your US, the growth of US is slowing down. UK has slowed down after the Brexit. UK has gone apart, has been torn apart actually. Europe has gone down after the Eurozone crisis. Africa and South America are not developing as they were expected to develop, as people in the developed economies are not ready to invest as much of money as they were supposed to invest because of their own fears in their own economies. So there will be a growing trend towards the commodities, and this is a good time. This can be a good time. In the next 10 years, we'll be seeing the collapse of a few fiat currencies of the world. I'm not saying the Indian rupee is going to collapse, I'm not saying Japanese yen is going to collapse, but we might see the collapse or the merger of a few fiat currencies. We might see the adoption of the Asian currency like the euro. We might have a currency as it was envisioned at the Asian Development Bank, because as individual currencies, our Asian currencies stand no value right now. We are at the brink of losing our entire value on our currency, because any way we go, either we go the RBI way or the government's way, we stand to lose in the short run at least. If you're going to look forward to building a portfolio, it is better to have your picks in good quality stocks, just good quality stocks, blue chip stocks, or large cap stocks, or extremely high growth stocks. Don't go for the middle ones. Don't go for penny stocks that have no growth potential but just speculative potential. Don't go for them. Don't go for operator stocks. Just because you got a call, you got an SMS that a stock is going to go places, don't go for that. But rather go for some good stocks that are going to grow, irrespective of the nature of the economy, that are having a global presence, that are having a multinational presence. Go for such kind of stocks, and your money will always be safe. And it is time for all countries of the world to stand up and recognize the alternative currencies, because the alternate currencies like the Bitcoin are having a bubble of their own. The cryptocurrencies are having a bubble of their own. If the governments don't stand to realize that, if the governments don't stand to protect that, if the governments let the bubble burst, or already we had a small burst of the Bitcoin bubble, the price has spiraled from $18,000 to just under 4,000 right now. And next Bitcoin is headed towards $2,900. So that is different. That is based on technicals, and that always works on Bitcoins. So that is different. But the governments have to recognize the fact that there is an unregulated derivatives market going on the cryptocurrencies or the alternative currencies. So the problem is that once this falls, this can trigger a massive worldwide banking and economic collapse. So the governments have to take cognizance of this fact, and the governments have to work with them or they have to stop them from working. The governments have either of these two choices. They can't go for both. So since many governments have already chosen to work with them, like the Russian government, which is building its own coin, the ruble coin, the US government, which supports usage of alternate currencies, we have to see a chain of events that are going to change our global economics. And if we don't, we are going to face a repeat of the 1920. Because this time it is not going to be a fall, my friends. This time, if it falls, it is going to take the entire banking system down. It is going to take the entire finance system down. So this time it is going to be a recession. It is not going to be a fall. 2008 was only a prelude. I again repeat. If this is not taken care of, we are going to see a huge, massive collapse. So the impact, the intensity of this is to the tune of $600 trillion, the global derivatives industry. And I'm not talking about current year's numbers. I'm talking about numbers 2 years back. God knows current year's numbers. So it is high time that governments tend to regulate these, or else go see them bust. Other than these negativity, other than these negative issues, when it comes to India, we have an extremely positive growth story ahead. The exciting chapter of India has just begun. After more than 70 years of independence, the Indian growth story has just started, and this time it is never going to stop. So we have a huge chance of going forward ahead of all our competitors, only if we believe in growth, only if we are ready to take risks. And that is what the present RBI regime was against. They were not ready to take the risks that mattered. They were not ready to sign those papers that mattered. This is a blessing in disguise if the government chooses to use it properly. I hope the government uses it properly, and if they don't, we always have the gold markets. Because once if we are pretty sure that the government is not using it properly, we're going to see a global meltdown, and we don't want to be invested heavily in equities. So we'll just move towards bullion. As investors, we are always going to have our day, but when it comes to the Indian growth story, it is never going to have an end. So with that, I complete this session. For any doubts, you can just put it on the comment section below. I'll be quick in answering. If you like this video, give it a thumbs up, share and subscribe to our channel. When you hit subscribe, don't forget to hit the bell icon so that you get notified of all our videos. We'll be uploading 2 videos a week, on one on a news topic and the other on either fundamental or technical analysis. Other than that, we also take classes. We also handle classes for fundamental and technical analysis, which are both live and online. So for all those details, you can always visit our website www.letslearnmarkets.com. Catch you guys.